Welcome to the Wheelbarrow Profits Podcast, where you get multifamily investing made real. Learn from top players in the real estate investment world as they share their secrets with you and discover proven strategies on apartment investing that actually work. To learn more about Wheelbarrow Profits, visit jakeandgino.com, your one-stop shop for everything multifamily. Now to your hosts, Jake and Gino.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, I am doing good. How are you? No Buffalo Bills this week, right?
No Buffalo Bills this week, but I got to visit my boy in St. Augustine. Had a good time down there with the fam for a few days, and enjoyed that.
That's right.
It was good. It's good. So, hey, before we get started, let's give a quick shout out to our sponsor, CrowdStreet, who knows you don't have to know a guy to find a quality commercial real estate investment opportunity. Learn more at crowdstreet.com/wheelbarrow. And for visiting their site, they're going to give you a free gift. That's so nice of them, isn't it, Gino?
It is. Great company.
Today's guest is Dave Zook. Dave has been an investor and entrepreneur all of his adult life. He invests in multifamily apartments and ATMs. I want to hear about these ATMs. That sounds kind of cool. Additionally, Dave has international real estate investment holdings in Panama, Canada, and Belize. He and investors own over 3,000 apartments, mostly in Memphis and Texas. So without further ado, Dave, welcome to the show.
Hey, guys. Thanks for having me on the show.
Hey, it's our pleasure. Tell us about how you got started, but when you get a second, tell us about these ATM machines. That's something new to me. I want to hear about it.
Yeah, well, how I got started, I sort of made up my mind early on in my career when I was still a teenager that I wasn't going to have anything to do with real estate or real estate investing. And the reason for that was my dad is an entrepreneur, and he owns a very good business, and we now have it as a family business with he and my brothers and I. But he also owned some real estate, and it was more. I don't know that I'd call him a real estate investor. He parked his capital in real estate, his extra money that he made from his business, he parked in real estate, and he self-managed some of that real estate. And I saw him self-manage some of the single-family homes when I was a kid, and I just decided, there's got to be a better way to make money than this. I saw some of the good, bad, and the ugly. And so I started out in business. I started a business or two, or I started a couple businesses. I partnered in some businesses, bought and sold, and got to the point where I started having a tax problem. I mean, some of these businesses were doing really well, and I wasn't at that time too educated on the tax law. I just was taught, and I thought that if you make a lot of money, you got to pay a lot of tax. And I got to the point where I was paying hundreds of thousands of dollars in taxes per year. And so about that time, I read Rich Dad, Poor Dad, and I started reading a lot of Robert Kiyosaki, and I kept hearing him talk about how you can make millions of dollars a year and not pay any tax. I was like, how in the world? That drove me crazy. And so I just kind of did a deep dive and got around Kiyosaki and his team. And I, got around the right people. And through that, I realized that real estate could be a real tax shelter if it's done right, and specifically multifamily. So I usually tell people I got chased into the multifamily space. It's not like I wanted to. I got chased into it for tax reasons. And, learning about Kiyosaki's, investing for cash flow, it was a combination of investing for cash flow and, even more importantly for me was the tax benefits or tax vehicle.
So can you go through a couple of businesses that you've owned and what business you're currently running right now?
Yeah, so the family business is a modular building business. We build modular horse barns, modular garages, and storage sheds, and we sell them and deliver them all over the country. Name of the company is Stolzfus Structures. I also own Stolzfus is an Amish name. I'm up here in Lancaster, Pennsylvania, the capital of Amish country in the United States. And then I own a company called Horizon Structures. We also we build and we sell and deliver modular buildings coast to coast and even some international. I owned a trailer business. We manufactured aluminum trailers. I since sold that business about 2 years ago. Those are some of the companies that I'm still involved in. I own a company with my brother and my dad. It's called Zook Cabins. We do modular cabins. So heavily involved in the modular building space.
So let me ask you, is that space or that building, was it cyclical for you, up and down, highs and lows? And did you see that as part of the problem with real estate?
I wouldn't call it cyclical. It's a little bit more seasonal.
Mm-hmm.
So right now in the middle of the wintertime is sort of our slow season. That's when we kind of reboot and recalibrate and kind of refresh and come up with new designs for the fall, for the new year.
Mm-hmm.
So yeah, we get a little break in the wintertime, but then we're off to the races again in the spring.
So what was your first multifamily investment?
The very first one of any size. I mean, I tinkered around with single family, and then I did a couple, 5-unit buildings, but my very first significant one, you're gonna like this, was a total bust. It was a 72-unit building that I teamed up with a guy in Memphis, and it turned out to be a real nightmare. Luckily, I didn't throw my hands up and go home, and I found another team, and I did a really good deal that we did really well on, and then I just continued to do business with that team.
So I like nightmares. So let's dive into the nightmare a little bit. Give me a couple of reasons why it was a nightmare. When I hear Memphis, the back of my mind says nightmare to begin with. I see Jake laughing because it's a hard market to get into. You really have to know the submarkets and the neighborhoods and all. So let's start outlining the mistakes that you made so the listeners can say, okay, I won't do that. I won't do that. I won't do that.
Well, you're going to hear me talk about the team quite a few times, and that was basically it. I teamed up with the wrong guy. And so, we've since then, we've done a few thousand units in Memphis and with, a lot of success. But it was, it's primarily a function of the team and how well the team has done. We've got the #1 broker in the city on our team. He and his small 3-man team have, they're involved in almost half the transactions in multifamily. 20 units or larger in the city. And so, yeah, you're right. I mean, it is a hard market, but if you have a really good team who knows the market really well and who, is entrenched in that market, you can do really well. I love Memphis.
So I'm not going to let that go. 72 units, because I got a couple questions backing that one up. But what did you do with the 72 units? Did you end up just either putting a bomb and blowing it up, or did you sell it, or how did you get rid of that nightmare?
I ended up selling it for about a $500,000 loss.
Okay.
It was ugly. I mean, it was, the plan was to go in and rehab and renovate and then, get, refinance all our cash back out, the story, how that works. And it sounded good, but, and it looked good on paper, but the guy wasn't able to do what he says he was going to do.
So what was wrong with the property specifically? Was it the area, the location, the tenants, the style of the building, the amount of work that you had to put in? Go through what was wrong with the deal.
There was a number of things. We since learned that, with my team that I have now, we since learned that area of the city is not an area we want to do business in. So yeah, bad area. But more than anything, it was just a lack of competence. I think it was, my then partner just wasn't able to kind of put the deal together the way that it made sense and make it operate.
So if you'd paid less for the deal, would it have made more sense? Because we always talk about the buy right. Was buying one of the criteria that was the problem? Did you get it at a good number, or was just a function that it just couldn't work at any number?
Well, a couple things. I would not have bought it for what we sold it for with the partner that I had. So could we went in with my team that I have now, and we discussed this. Could have I went in with my team and took it over? Had it been in a good area of the city where we'd have liked to do business, that's probably what would have happened. Mm-hmm. We would have came in with my team that I have now, and we would have took over the building, and we would have made it operate. But it was again, it just wasn't in a very good area of the city, and it wasn't in an area that we felt that we wanted to have a presence in.
So
Talk
then
about
what
Memphis a little more, though, about that, because I think people get attracted by the price per unit there because it's typically lower than everywhere else in the country, basically. But there's a lot of pitfalls there, such as physical vacancy versus economic vacancy in parts of the town that you like to avoid. So maybe throw a few tips out there for the people that are looking at Memphis saying, I like this area, I don't like this area, and some of the pitfalls that you see that are kind of exclusive to Memphis. Maybe not exclusive, but more common there than other parts of the country.
Well, number one, yeah, and I agree on the unit cost. And I would just say that for someone going into the city, go find a really good rockstar team first. Don't worry about the unit cost. Don't worry about don't even focus on the asset. Find the team, and then most of what we own, just for proximity base, most of what we own is down on the south and the southeast side of the city.
Mm-hmm.
You get over to the east northeast. That's kind of more the affluent, A B plus side of town. But most of what we own is down on the south side and sort of the southeast. There's just all kinds of activity going on down there. The airport's down there, FedEx down there. You got a lot of industry going on down there, and that's where most of the jobs are. So we love that part of the city.
So I hear in the background my mom saying, Gino, I told you were going to fail. You crapped out. You lost $500,000. You should just quit right now. What made you stick to Memphis, and what made you stick to multifamily?
Well, I knew enough of folks in the business that I knew that, it wasn't the asset class. I knew that wasn't the problem. And so when I got around the right team and got around a partner that, we soon after we did this deal, I teamed up with him and did a 92 unit building. It was kind of a test. It was kind of a, try it again kind of a deal, and got into it with a 92 unit building. That deal worked out really well. I liked how my partner was communicating and what he was able to get done. And he also had a track record of success. That's a big one. So, if you can find a partner or a team that has a track record of success, that's a big deal. So we ended up doing that deal together. I really liked it. We did another one. We bought a couple hundred units of our own before I was a syndicator. And that was lucky for me. That 72 unit deal, it was all my cash. It wasn't a syndicated deal. But it was a learning experience, and it was a good experience. I mean, would I want to go through it again? Absolutely not. Am I glad I did? Oh my, yeah. I mean, they say you learn the most through going through experiences of extreme pain or extreme pleasure. That's when you kind of absorb the most.
Uh-huh.
For me, I learned the most on that deal, and so when I talk about team, it's not that I was born with that instinct. It was pounded into me, and I took it as a lesson, and I wouldn't trade it for anything. I'm glad I went through it.
How did you finance that 72 unit deal?
It was all cash. So there was another mistake. It was my first time deal with this guy. He was a great sales guy, and I was convinced this was the best deal. This is the best thing that ever happened in real estate. So I ended up going in as the only investor in his syndication.
And he told you to pay cash for it?
Well, it was a heavy rehab, and
I guess
the idea was we were going to go in and cash, get it stabilized, and then refi our cash back out.
Gotcha.
Sounded good, and
it is good. No, it's a good strategy. It's a great strategy if you can execute. We know a lot of syndicators who are doing it. That might be a little bit difficult for your very first deal. Maybe that was probably another one of the issues, but that if you had done this on your third or fourth deal and not do the heavy value adds. Now we're into the light value adds. At least you're pitched to heavy value adds. So, and you're in the business. So see, maybe that's part of your mistake also, that you're a builder and you can understand the concept and you think it's, so maybe that might have been part of the problem of you looking through it. But a guy like me sees that, I'm running far away if it's my first deal. I don't really want to look at heavy rehab like that. So that might have been part of the issue, don't you think?
Oh, I agree. Totally agree. I got sucked into the story and I went all in, and that was mistake number one.
That's fine. That's fine. We all make those kinds of mistakes. Please, if you don't make those mistakes and take those lumps, you'll never experience it, and you never get out of your comfort zone, and you'll never grow. How did you end up finding the broker? Because Jake and I preach this all the time because we have students and members coming to us. How do you find deals? How did you find the broker in the market?
I went on a 3-day investor tour to Memphis, and the Woodyard Realty, Steve Woodyard was.
Oh yes, yeah.
He did a couple hour, or he did an hour or two session with our group, and I liked him, and I followed up with him soon after the tour was over, and I said, hey, I want to do a deal. I want to buy a multifamily building in Memphis. At the time, I was, I thought I was going to go down there and hook up with a property management company, and when I told him what I wanted, that I was wanted to take sort of a passive approach. I wanted a really good management team. I wanted somebody that, I didn't have to get on a plane and go down to Memphis once a month to take care of issues. I wanted to be able to have that management team that would take care of that stuff for me. When he heard what I wanted, he connected me with his number one investor, or buyer rather, customer, and said, look, you guys really need to talk. You guys think the same about investing. You guys, I think there'd be a match here. So he connected us, and we got on the phone, and my very first reaction was like, yeah, I don't need a partner. I think, I just need a really good property management team. I had just, come out of that situation where I wasn't real happy with my partner. So I was like, you know what, I want to do this one on my own. But he kept throwing in a little comment about this guy, his buyer, who had just bought 800 units from him over the last 2 years, and was timing just worked perfect. I mean, this guy was still in the market wanting to buy more units, but he was sort of out of cash. And I was coming into the market with cash, but I needed a good team. So he hooked us up. We did a deal together. We liked each other, and we've done several thousand deals since then.
So how do you find deals in the market? What's the number one criteria you use to find deals in your market?
Mostly it's through our broker, Steve. He's very active in the market, obviously, and he's, most of the deals that we do are off market. So he'll connect us with people in his database who, own multifamily that, don't even have them listed. He'll go through his database and find deals that he knows would be a good fit for us and make that connection. That's where most of our deal flow comes from.
Mm-hmm. And Dave, how did you show him the credibility that you had to hook up with him and give him the confidence? How did you sell yourself on him, since coming off a 72-unit crap deal and you're like, okay, I want to invest? How did you show confidence in yourself to him? How did you pitch yourself to him?
Well, early on in the relationship, it was with cash. I mean, he came in and showed that I was able to get it done.
Okay.
Showed that I was financially able to get it done. And then we just, it went slow at first. It went slow. It went, we did that deal. It worked out great. I did what I said I was going to do, and he did what he said he was going to do, and sort of just evolved from there. So it was, it was a situation where, we sort of felt each other out and realized that we liked each other and got along well and sort of thought the same about investing and what it takes. And so I was, at the time I was just on it on my own account. Since then I started syndicating these deals, but that was never the intent for me. I didn't start out on this journey thinking that I was going to be a syndicator. I started out with a problem. I had a tax problem. And so I got, it just sort of slowly happened.
So you spent 3 days down in the market. What did you really like about Memphis? Because a lot of guys have problems starting. So what was like the big thing? Because you spent 3 days down there, and that's really huge for people to get to know the market and to get to know it implicitly. What was the thing that stuck out to you in Memphis, and even where you are in Texas right now? What do you like about those markets?
Well, the two things that I like, that those markets both have in common are the landlord-tenant law heavily favors the landlord. The other thing I like about both markets is jobs. There's a couple of things that we really like when we go into a market. The jobs, I like to see where the jobs aren't the kind that you can easily outsource or ship overseas. Medical is one. Distribution is another one. And then, of course, natural resources, or let's say there's oil jobs or energy jobs. So if you got energy, distribution, and medical, those are sort of anchor jobs that they're not going to get shipped overseas next year or the year after. I mean, they're going to be around for a while. So those are some of the, if you look at Memphis, there you have medical and you have distribution. You got FedEx, and a lot of the FedEx is kind of your anchor tenant. And then you got a bunch of industry built around FedEx. Nike is in town. A lot of sort of shipping intensive companies are based in Memphis. So I would say jobs, landlord tenant law, and the sort of jobs that were there. So low cost of living is another one. No state income tax. It's just a very friendly state to live in.
It sounds like I'm talking to Jake now.
What are you still doing at PA, man? Get out.
He's talking about guns soon. I'm like, wow, this is Jake part 2 over here. What is your buying criteria? What are you looking for as far as cash on cash returns? I mean, cap rates. What really excites you in a deal right now? Because what was 3 years ago, we were looking at 8 and 9 caps 3 or 4 years ago. Now, if we can get a 7 cap, we're happy. We're always looking for the 10% cash on cash. What are you looking for in a deal?
Pretty much same sort of criteria. I mean, your target is always to get in that double-digit cash on cash return range. Typically, we'll buy, and I'll give you a couple examples. One, I mean, we're always looking for value add, as you know. If you go into, if you're going into a stabilized product and hoping to make a double-digit return, those assets pretty much don't exist anymore. But if we'll go in. I mean, an ideal product for us is something that's high 70s, low 80% occupancy. It's something that needs not super heavy renovation, but heavy lipstick. Some paint, replacing soffits and fascia, replacing driveways, parking lots, carpet paint, that kind of stuff. So we'll go in, and we'll go in and buy those deals and get them up to 90% occupancy, and then do a refinance. But here's where I found in the last year, especially year and a half, or 2 years especially, is if you've got a really good team with a good track record in the city, and you've got cash, and you're patient, you're in the right time, or you're in the right place at the right time with cash, that we're still finding a good deal now and then, but it's definitely harder. I mean, it's a lot harder than it used to be a couple years ago when there was deals everywhere. But having the cash, being in the right place at the right time, and having a team and a broker who can tell the story well. If you can go to a seller saying, look, these guys, this team, I know they're not bidding the highest. I know they're number 3 on your as far as where the bid is coming in at. We might be $200,000, $300,000, $400,000 less in our bid, but if he can go in there and sell us and say, look, these guys have closed in 25 of their last 25 transactions that they put under contract, that's showing up strong as a buyer. And then if you can waive some of those financing contingencies, I mean, the last couple of deals we bought were cash, going in with cash, and then in the first 12 months doing the fix up and kind of sprucing it up, and then go get financing. It gives us some flexibility, and it makes us show up a lot better as a buyer.
What are cap rates in the market that you're predominantly buying? C plus, B minus assets? C
plus, B minus. Yeah, I mean, they're kind of ranging between 7 and 10 still.
Okay, so that's actually not bad. That's actually pretty good. If you can reposition it to 11 and 12, that's where you're really making your money, correct?
Yeah.
That's awesome.
Yeah, so I'll tell you, it's not easy, and especially not if you don't have a sort of team or track record in the city. If you're coming in fresh, it's gonna be a tough fight, but it can still be done. But it's gonna be a lot harder.
So, Dave, go through the other team members that you think are really vital in the real estate process, as far as an accountant, attorney. Who else did you think was really crucial to get on board?
Well, first and foremost is the property management team. It's kind of, we sort of have a unique relationship down there. My partner, who he and his team live down there, is also a property manager. So he is not a third-party manager. He only manages our assets. But I would say first and foremost is the property management team. I mean, it's going to be his job. It's going to be their job to make that property perform. And, you know, that for us is key. As far as attorney, CPA, yeah. So I'm a Provision client. I'm with Tom Wheelwright and his team. So that's important. That's important to me, just simply because I now understand the tax law, and I now understand that, you know, that old adage of, you know, if you pay a lot of, you know, if you make a lot of money, you got to pay a lot of tax. It's just not true if you are strategic. If you have good team members, if you got a good CPA. I mean, we're constantly back and forth. We're talking, especially now with the new GOP tax bill that came through. And February 15th to the 19th, I am heading off to Belize, and I'm going to spend 4 days with my CPA in Belize. And we're going to be talking. We're going to be talking a lot about tax and the new tax bill. And the timing is not an accident. You know, I gave him about 2 months to get his mind wrapped around the bill and how it's going to affect us. And so we take a very strategic approach. So yeah, CPA is definitely a must-have if you want to, you know, operate in that tax-free range.
Now, this question, I guess, is a little bit more for me and Jake, because we're at your point. We've bought all our properties ourselves. We're almost at 1,000 units, but we're at that point right now that I think we need to syndicate our next deal. What was your first deal that you syndicated, and how did you come to the conclusion, like, yep, I got to start syndicating now?
All right, so I'll tell you how I came to the conclusion first, and I'll talk a little bit about the deal. It's a pretty simple deal. Actually, you know what? Let's do it the other way. It was a 164-unit multifamily building. I needed, it was less than $1 million to get the deal done. We had Fannie Mae or Freddie Mac. It was one of the agency loans. I think it was a Fannie Mae loan. So we needed to come up with the 25%. Didn't need a whole lot of rehab money, but renovation money. But the way that we, I told you I went into this business not thinking that I was going to be a syndicator. I did it for myself. Well, I was invited to sit on the board of a local startup bank. It was a local community bank, and I was invited to sit on the founding board. And so I showed up at these first couple meetings. It was, by the way, it was the first bank that got issued a charter license since 2008. When that whole thing went down, charter license they weren't issuing. Well, this was the first bank at Burdenham was the first bank that got issued a charter license. So I got invited to sit on this board when it was still just an idea. And there was probably 12 of us in that meeting. And I knew most of the guys sitting at the table there. And I knew that they were very well respected, very well connected businessmen, and well able to write 7-figure checks to get this bank started. I heard some side conversations like, well, I don't know, if this is a real good idea. As an investment, we might not see our money. We might not see any kind of return for 5 to 7 years, but they thought it would be better than putting their money in a CD, paying less than 1%. And
I'm sorry, I'm seeing everything come together with
oh my goodness. I was just like, you've got to be kidding me. Some of these guys are making their investment decision based on what they can get on CD. So I went home. I couldn't forget about this. This was like crazy. We were in Memphis doing, making double-digit returns and just having all kinds of fun. And so one of my friends was also on the board, and he's now the chairman of the board of this bank. But back then he was, he was one of the 12 guys that was there, and he's a CPA, and he was doing some of our bookkeeping, and he knew what we were doing in Memphis. So I said to him, I said, did you hear that? Did you hear what I heard? Like, you see what we're doing in Memphis. Do you think there's a way that we could bridge this gap? I didn't even, this was, I didn't even know how to spell syndication at the time. So surely there's a way that we can bridge this gap between these guys, making less than 1% in a CD and us making double digits in multifamily, we should be able to connect these guys, right? Do you think there's a need for that? And he said, well, absolutely, there's a need for that. So that's where kind of the syndication light came on.
So walk us through that first syndication. I mean, how did you pitch it to them? How did the deal go? And I guess more importantly, how did you rectify in your mind that you're not going to get all the equity? You have to share the equity on this one. Was that hard for you to get over?
Not really, because at the time I had just bought a couple hundred units myself.
Mm-hmm.
And at the time it was either we do it in a syndication or we don't do it at all.
Okay.
When you look at it from that perspective, then it becomes pretty easy.
That's right. Okay.
And so it was at the time where I knew I had to slow down if I was going to keep doing it on my own, or I could go full speed ahead and do it with investors. And one of the things that, I'm sure you're aware of, that once you become you get the number one broker in the city on your team calling you on these deals that are, too good to be true almost. And you want to continue being that number one call. You want to be the guy that, when you get that number one broker in the city, you want to be on his, on the top of his call list. So one of the kind of pressures that I felt was, if I slow this thing down and don't perform and I don't buy stuff that he brings my way, that buy great deals, I'm going to drop down to his number 2 or number 3 or number 5 call.
Mm-hmm.
And I didn't want that. So that was another decision that made that pretty easy.
So how did the deal work? I mean, as far as numbers and as far as repositioning, everything work out on the deal?
Oh, it was great. We are probably going to be refinancing that deal here in the next year or two. It worked out well. Those investors are still getting the double-digit return, have been for all these years. It was a between $2 and $3 million deal. I forget the exact numbers, but it was between $2 and $3 million. We had to bring $850,000 to the table. I had to go out and raise it, and I was incredibly nervous. I had never raised money for a deal before. So to go out and to these businessmen that I knew that were well connected and able, I had to number one, I showed them what I had been doing over the last year or two prior to that. I was able to go in showing them a kind of a track record of success already in the multifamily space. So that was helpful. But I showed them the deal, showed them the plan, showed them a couple of the prior deals that we had done on our own, and then asked them if they wanted to join us. And it really funded really quick, and it was much easier than I thought it would be.
So let me ask you, how did you set it up? Did you have any acquisition fees, general partnership, limited partnership, any preferred rate, waterfalls? Let's talk about that real quick on the deal.
There was not. It was a 75-25 split. So 75% of the cash flow went to the investors. It was 75-25 split on the cash flow and the equity side. The promote fee, I think, was, I don't know, it was like $25,000 at the time. It was really, really thin margins. It was tight. And we, knowing what I know now, we probably went in and raised, $950,000 or $1 million to make sure that, we were covered. I actually had to come out of pocket on that one because I didn't raise enough. But, that was another lesson. It was, I was trying to stay as tight and conservative as I could. I actually had to come out of pocket, bring it to closing. But and I always invest in my own deals. So I was in that deal for 100 or 2 myself, and then still had to come out of pocket. But it was a learning experience, and we got the deal done. And I think for folks out there that are wanting to be syndicators, I think that's the way it should be done at first. Get your keep those margins slim, especially on your promote fees, especially, get yourself a track record of success, and then you can kind of, pad yourself a little bit. But, early on, especially, it was tight, but we got the deal done, and it worked out for everybody, and they loved it, and they told their friends, and we got to the next deal, and it sort of grew organically from there.
So Dave, on the back end now, are you going to refinance the deal? Are you going to refinance the deal, keep the investors in, or just pay them out and you're going to hold the asset yourself? What is your strategy as far as?
Oh no, they always stay in. They're equity investors, and they'll stay in the deal. Okay. So the goal would be to get them all their cash back, and they get them all their principal back, and they stay in the deal with us.
Do they get diluted in their equity though?
No, equity percentage stays exactly the same.
And are you going to split the back end refi 50-50, or you're going to give them 75, you 25? How does that work?
75-25 on that one.
Jake.
Since then we've turned it into, I mean, the deals that we do now are a 50-50 split on the backside.
Okay. Well,
but as you know, C-class multifamily is a heavy lift, and so we feel like if we bring the value and really make that thing perform, we're incentivized to really make that thing perform on the back end. It is now 75-25 cash flow, 50-50 on the equity. But in the early days when I did the first couple, it was 75-25 all the way through.
Well, it's great because I have a lot of people asking me questions, a lot of Jake and Gino members, how should I start? And they're always wanting so much more in the beginning. And you at least have a lot of credibility. They have very little. So I'm like, just get in the deal, get whatever you can get. You know what I'm saying? It's like, just start out. And if you never start, you never get that first deal. That first deal lands you to the second deal and to the third deal. And if you do perform, and when you do perform in the first one, the sky's the limit for going forward, isn't it?
I would agree. Definitely stay skinny on the front side. If you're a beginning syndicator, I mean, don't worry about making your money on the promote or on the front side at first. I mean, if you get the track record and you earn that, sure, you can get that later. But just get out there and do a deal and make it work. Make your investors happy. I always say the best way to communicate with your investors is with a check. So just make your investors happy, and you know that you can add some margin on the, you know, in deal number 3 or deal number 5 or deal number 10. Don't worry about trying to get it on the first couple deals.
And Dave, how did you feel? Were you intimidated actually getting investors on? Because Jake and I are at that point that we make a mistake. We don't get paid 1 month. It's our deal. How did you feel about that? How did you get over that fear of saying, wow, I've got to write these guys a check every month? I
mean, it kept me awake at night in the beginning. You know, it was incredibly, you know, it's a lot of pressure. You know, you're dealing with people's livelihood. You're dealing with their, you know, it's serious business. So yeah, it was something that weighed heavily on my mind, and still does. I mean, you know, it's a serious business. You're dealing with other people's capital, and you know, you don't want to let them down for several reasons. One is, you know, it can kill your momentum. You know, you get a couple of bad deals and start underperforming for your investors. It's a great way to kill your momentum.
Well, I like the fact that you have your own money into the deal. That's what we want to do, because at least you have your own skin in the game. So if they're losing, means you're losing also. So you're having confidence in the deal. So I really like that strategy about doing it.
Well, and that's one of the deals. That's one of the things that I always look at, because I also invest in other people's deals. So it's one of the things that I always look at is the promoter getting paid when I'm getting paid, or how is the deal structure set up? If he's getting, you know, if he's making all his money on the front side and fees, and then I'm getting all of the, you know, I'm getting most of the backside, that's not a good setup. You want to get paid. You want your incentive. You want to be aligned with your promoter and make sure that you're getting paid together. So that's very important to me.
So on the back end, would you rather sell these assets? Like a lot of syndicators seem like they want to sell the assets. Would you rather sell the asset or refi it and continue, you know, that golden egg instead of looking for another golden egg? What's your strategy on that end of it?
You know, we're getting ready to sell one. We're getting ready to sell an asset. And, you know, I'm not saying I wouldn't sell, but I really prefer to refi. I mean, it's so hard to find deals that work in this market, as you know. My thought is, why would you want to sell it?
Yeah, why are you selling?
Now, with that said, you know, we probably will sell one or two just because of the ridiculous
valuations.
But you know, and there can be a time when you can take some cream off the top and take some profit. But it's, you know, again, when you look back at the very reason why we got into this business, you know, one of the reasons was tax. And so if you sell, unless you 1031, unless you have some, you know, some property rule into, you know, it can kill that thought. So, you know, I prefer to refi.
But so Dave, is it gonna still though cash flow? I mean, if you refi it, couldn't you just get your money out tax free that way? And then, or are they going to pay you more than your refi value? Because at some point you know, the appraisal is going to come in and it's got to at least, you know, appraise, you'd think.
If we sell, it's going to be at a pretty extreme, you know, premium.
I got you. Fair enough.
If we get in somebody's way and they come in and do it, you know, I'll just give you an example. I was going to save this till later, but one of the properties that I'm excited about is a property that we bought, for $6 million in the spring, less than a year ago. And we had a guy come into town with $30 million, and he wants to buy that property, and it's under contract right now for 10. So we bought it for 6, put a couple $100,000 into it. He wants to buy it for 10 through a 1031 on his side. He sold some assets in Florida, and he's bringing us the money. So a situation like that, when you can make that kind of money, and you have an asset that you can roll into. Now, obviously, that's very important on that deal because it's short-term capital gains if you don't use the 1031. So we're gonna protect if that deal goes through, we're gonna protect our investors, and we'll have a really good asset that we can roll in.
You're not interested in owning that asset at 10?
No, the amount of equity. I mean, the return on equity is pretty crazily zero. I mean, you have $4 million built on equity. What is that returning? I mean, it's just. I think even taking the capital gains hit, even if you have to pay.
No, that's what I was saying. Refi. Like if he refied at 10, I was just saying you're not interested in owning it basically at 10. If you refied it, the 4.
We can do better. We can do better than that.
Yeah.
Yeah.
No, that's fair.
Wow. I don't want to get into ATMs. I'd rather talk about multifamilies for the rest of the call, to be honest with you. But
come on, man. I want to find out about the ATM. Just thumbs up or thumbs down on the ATM. You like them or you dislike them?
I love them. I mean, I'm heavily invested in that too. I mean, this last fund that we did right at the end of the year, I added 2 more units. And when I say a unit, that's $104,000 and it's 7 machines. So one, I added two more units to my, to my own portfolio. So, no, I love them. I'm heavily invested in multifamily and ATMs. And, there's some unique, some of the core reasons for investing in ATMs fits right in the reason that we invest in multifamily. Strong cash flow and heavy depreciation. I mean, you can write these things off. You can write off your whole investment in 5 years.
Nice.
So it makes it a very, very tax-friendly investment. You get a lot of tax-free income from them.
How did you get into the ATM space? I mean, who introduced you to it?
So one of my friends, who's now an advisor on my team, introduced me to a couple of his friends that he had invested with and who were heavily involved in the ATM space. So back in 2012, he introduced me to these guys, and I started investing passively with them. Invested in a couple rounds with them, really liked the guys, got to know the guys. They're local guys to me. They're up here in Lancaster. In 2016, the friend of mine who's on my advisory team went to these guys and said, hey, you really should think about bringing this guy on board, bringing me on board. He knew I had built quite a network of investors for the multifamily space. And so they signed a big portfolio. What they do is they'll go out and find, several hundred locations and buy the locations in a portfolio. So they had just bought a big portfolio and they needed some help. So he, again, sort of reintroduced us and said, look, you should really team up and take this thing down together. So they gave me, at the time, I was like, nah, doesn't really, I don't know that it fits with my investors, and I was sort of busy, and I had a couple multifamily deals that I was trying to get closed, and so I sort of shelved it. But then at the end of the year, they came back and said, hey, we got a special fund open right now that's Section 179, meaning you can take all of the depreciation the very first year. You can write off your whole investment the very first year. Would you like in on this one? And I said, look, I really like this space myself. There's probably no reason my investors won't like it. So I did. I sent it out to my investor group, and just like that, I sold a bunch of units, and they asked me to come on board and partner with them. So since then, in the last year, I raised almost $20 million in ATMs.
Wow.
And my investors love them. I mean, I started doing this a little over a year ago, and I've had investors who bought one in the first round and then bought a couple more and then bought a couple more, and just in the last round, I've got some investors that are up to 7, 8, 9, 10 units.
That's awesome.
And they're loving them. So it's been a very popular asset class.
Last questions before the short rounds. I wanted your best tips on raising capital, because it seems like that's your number one priority is raising capital. And I guess your best tip on multifamily investing.
Best tip on raising capital, I would say just go out in the world. I got a good book suggestion for you guys. It's The Go Giver by Bob Berg. If you go out in the world looking, and again, you mentioned you got guys that want to come into this space and make a lot of money on their first deal. That should not be your number one priority. Your number one priority should be to go out and add value to your investors. If you go out with the attitude that I'm going to add a lot of value to my investors, your deals will get funded, and you're going to have a lot more success and get a lot more momentum that way than trying to figure out how much money can I make in this deal. So I would say go out in the world and look to add value to people in your community, people in your network, and make them wealthy.
Mm-hmm. I like that.
Guys, let's give another shout out here to CrowdStreet before we keep this moving. And they believe that investors of all sizes should have access to quality commercial real estate investment opportunities. The CrowdStreet marketplace features vetted commercial real estate investment offerings from over 100 sponsors from across the U.S. Download a free copy of their commercial real estate investing guide at crowdstreet.com/wheelbarrow. And what about you, Dave? You on the CrowdStreet bandwagon there yet or no?
Not yet, but I want to hear more about it.
We're gonna make an introduction after this. We're gonna sell some product today, Gino.
Well, listen, they're a great platform. Darren Powerley, we pretty good friends with him. I would check them out because their CRM, their back end is great. It's probably right up your alley. They have a great place where you can actually put your deals on. You throw your deal on there. If your deal gets selected by them, they've got tons of accredited investors on there. But we like the back end also, and we're going to start using it. We haven't syndicated yet, but definitely.
We're building our investor base on it right now, though, so it's pretty cool. It's a good CRM as well.
I'm looking forward to hearing about it.
What about the mobile homes, man? I'm thinking about this. You got the manufacturing going. You got the background in the multifamily business. When are you going to start becoming the Jim Clayton and start cranking out some mobile homes out of your factory there?
That's really not our target market. Most of our products are geared more toward the kind of upper middle class. And when I say that, it's people that own their own properties. When you're buying a modular horse barn, you own your property in 5 acres.
Mm-hmm.
When you're buying one of our modular cabins, that's most likely your second home. When you're buying a modular garage, it's probably going to be going on your own property. So I love the asset class. I would like to be a mobile home park investor at some point. I love that asset class, but I don't think we're going to be building mobile homes anytime soon. That's kind of a different market.
Had to ask.
Oh yeah.
I think just to piggyback off of some of Gino's questions earlier, you went from, similar to us, just buying your own, putting your own money in, buying your deals. How have you liked being a syndicator up to this point? Are you happy you made the jump? And if you had to do it over again, would you still do it?
Absolutely, without a doubt. It's one of the best things I ever did. There are a lot of people in my network who I'm now good friends with who I wouldn't even know if I hadn't started in this space. So I love people. I love doing deals, and it's for me, it's a natural fit. I love it.
Cool. This is a little more like general business stuff, but what is your best habit for success? You've obviously built up a nice portfolio. You're involved in multiple businesses. What is something that you do on a daily, weekly basis that's contributed to your success?
Probably, a couple things. One, I read a lot. So I'm always reading something. Number two, I think one of the number one secrets to my success is when I look to enter a space, whether it's ATMs or whether it's multifamily, whether it's self-storage, whatever it is, the very first thing I do, I don't put as much attention on the asset class or a specific asset. Let's say there's an asset listed on whatever one of the exchanges, MLS or whatever. I don't get real excited about the asset until I have a really good team. So I've done this several times in several different asset classes. When I know there's an asset class that I want to invest in, the very first thing I'll do is go find the best people in that asset class that I can find, and I look for a way to add value to them and partner with them. So just a real shortcut there, because you know what? If I would spend, you know the rules about the 10,000 hours, the 10,000 hour rule if you want to become a professional at anything. Well, we all only have so many 10,000 hours in our lifetime. So if I can tap into somebody that has that 10,000 hour rule already under their belt, and I can team up with them, partner with them, that's a real shortcut for me. So being able to find good people and team up with them has been a big part of my success.
And I think if you'd have gone back to that first deal that you did, that 72 units in Memphis, that was it was a mistake, but you learned from it. And I think now it's led into sort of your philosophy or your outlook on business is that team, partner with the right people. Because if you would have gone back, you would have partnered with the right people there and avoided that mistake. But that mistake essentially shifted your mindset and has you laser focused now on teaming with the right people so you can grow faster and get further ahead. So I think it all kind of comes full circle for you at some point.
Absolutely.
That's pretty cool. I read The Go-Giver a few years ago, by the way. It's a pretty cool book. Yeah.
I like to read it at least once a year. It's a really good book. It's really easy to read. And it's some good reminders in there for me.
You got the restaurant guy in there too, Gino. Have you read that one?
No, I haven't.
Oh shit! You got to check it out, man. What would you say your best deal was and why?
We bought a 286 unit, sort of a hotel, but it's sort of set up. It's a hotel, and we converted it and turned it into a multifamily, long-term living kind of deal. It's in a very good part of the city. That deal, we're just killing it with that deal. Getting ready to refinance it here in the next couple months. Those investors have been making in the teens cash on cash return. Now we're getting ready to refinance, and it's just been a really good deal. It's a good story because we took it from sort of a short-term kind of a nightly, weekly stay to a long-term residence. So that deal really turned out well for us, and I'd like to own about 10 more of those.
Jake, that is a fixer J right there on a big, massive scale. That reminds us of our first deal. We did a 25 unit. The only difference is you have another zero, so you're going to make a ton more money. I mean, so think big. Our first deal was a 25 unit. It was weekly renters, and we actually went to long-term monthly. And the value adds that you probably are reaping on that one must be awesome.
It is. We would like to do a bunch more of those. That has turned out really well for us.
That's great.
Well, I've seen a lot of these old hotels though, and then they're sitting there and people are wondering what to do with them. How many square feet roughly, if you remember, are the rooms, and did you knock down walls, or are you making them studios? Like, what's the makeup of the unit mix now?
There's you know what, I don't know off the top of my head, but I'll shoot from the hip on this one. There's some 1 and 2 bedrooms. I don't know exactly what that mix is, but there's a lot of 2 bedrooms in that building.
That's awesome.
No, I mean, that makes a huge difference, because a lot of the struggle with these things are you're getting, 400 square foot, 300 square foot rooms. And it's like, and turnover is going to be the biggest cost. So if how many people are you going to be able to get in a studio? And that's always like the struggle mentally. But I mean, if you have something that had rooms that big, I mean, that sounds like a no brainer then. So,
yeah.
What project are you excited about right now?
Right now, I'm getting ready to close next month on a self-storage deal. It's my very first self-storage deal. And it is a deal that I'm doing with partners again in Florida and Atlanta. I got introduced to these guys through a couple investors in my network who had done a total of 11 separate deals with these guys, and couldn't say enough of good things about them. One of the key principals flew up here to meet me, and we spent the day together. I took him into a very good friend of mine here in Lancaster who not only owns a bunch of self-storage assets himself, but he also sat on the board. In fact, he was chairman of the board of the National Self-Storage Association. Good friend of mine. I took my partners here in this self-storage business. I took him up to John's office, and he and another advisor friend of mine sat down, and we kind of peppered him for the next 90 minutes, and he passed the test. And after that, then I flew down to their headquarters and met their team and saw some of their assets, and so it looks like we're going to be doing a deal together. So I'm excited about that. I'm excited again. It's not as much an excitement about that specific asset as the team. I'm excited about the team and what we're going to do together in the future.
Very nice. What's the best way for listeners to get a hold of you? And is there anything, you have anything out there that you want to promote right now? You have any deals in the hopper? You got any other things that you're working on right now that you'd like to get out there to the world?
Yeah. So my website is therealassetinvestor.com. If you want to reach out to me or my team, you can reach us at info@therealassetinvestor.com, and we'll respond. If you send us an email, we'll respond to you. The other thing I have that I would like to send out to your listeners, if you're interested, is I have a little kind of ebook that I wrote up. It's called 8 Real Life Lessons for Syndicators and Their Investors. I'd be happy to give that to you guys.
Absolutely.
You can
Great.
put it up on your show notes, or I can send it out to the folks that email in. So if you email me, we'll send you a copy. I'll send a copy to you guys too.
Yeah, we'll definitely include that in the show notes. Gino, anything else?
I could probably talk about multifamily for another 2 hours here, but I like his transition. I like his story. It's great. You have somebody who started with cash. I think the biggest takeaways for me, Jake, is number one, get yourself educated. Number two, you don't have to spend 10,000 hours to become a professional. But at the same time, Dave brought a lot of value to the people that he was partnering with. So don't expect to become a partner, or don't say, I want to look for a mentor without actually adding value to that mentor. So look at it from that perspective also. I think that's truly important. I think number three, learn the market implicitly. Before you go and invest in Memphis, or you go invest in Fort Worth, Texas, or you come down here to St. Augustine, learn why you want to invest in the market. And then from there, start building a team, and then start analyzing deals. Don't start analyzing deals before you know what the heck you want to buy and where you want to buy it. I think that's really important. And I guess if you're going to become a syndicator, don't think about yourself, especially in the first deal. Try to really hit a home run, or try to at least get a double or a triple. Try to give your investors more of the deal. Don't worry about the back end as much, and try to create a track record and get credibility from that deal. I think those are the biggest takeaways for me. What about you, Jake?
I'm just wondering, is it going to be Florida, Texas, or Tennessee when you finally get out of the Northeast? Which one you going with, man?
No, it's going to be Belize.
Oh yeah, you really just saying screw it, I'm out, huh?
No, I like Pennsylvania. If you could calm these winters down a little bit here in January, February, they'd probably be a lot better. But no, we own some property down in Belize, and I'm looking forward to getting down there for part of the winter. So
that's great. That's awesome.
Yeah. Fair enough. Dave Zook, everybody. Dave, appreciate your time.
Thanks,
All
Dave.
right, thanks, guys. I enjoyed it.
Thanks.
We trust that you enjoy the Wheelbarrow Profits podcast. Visit jakeandgino.com, your one-stop shop for everything multifamily. See you next time when Jake and Gino share more of their investing secrets with you.